So I want to introduce somebody who doesn't need any introduction whatsoever if you're in the fintech world, anywhere on this planet and in any company, any organization, you'll have heard of the name Chris Skinner. And we're extremely fortunate to have Chris here today from the, I don't know what time zone you're in, because you travel as much as I do, right? But whatever time zone you're here now, and we're looking forward to your presentation. He's going to give us an overview of banking disruption and various other topics. So up to you, Chris.
Load of the slides. Thank you, Indiana. And good morning. It was interesting, Michael's slides just said that he's just added countries like Pakistan and Rwanda. And I've just been in Pakistan and Rwanda in the last month. In Pakistan, a country of 200 million people, only 20 million have bank accounts, 1 in 10. And yet in the last 3 years, 42 million have mobile data network services, so they can be included in the network. In Rwanda, there's actually a ATM every 5 meters. It's called a human mobile money agent. So financial inclusion through digital financial services is definitely happening. And I spent a lot of time with Costa Peric of the Bill and Melinda Gates Foundation, who's a champion in this space. But I'm not going to talk about that in the next 15 minutes. We can talk about it in the Q&A. But I thought I'd talk about what comes after banking. Because we need banking, but we don't need banks. And that's been a key comment of the last 20 years with technology. And for those who are not aware of what I get up to, I guess I'm known in this space because every single day I write on average about 700 to 1,000 words on a blog called thefinancer.com about technology in finance. And I've been doing that for over 10 years religiously every single day, because I'm rather passionate about the subject. I think it's quite fundamental to the future, and a lot is happening that's changing our world, particularly our world of money. And I don't think enough of us know the outcomes of that world, but I try and get to grips to grapple with what are the outcomes of this digital revolution that we're going through, and how will the future of finance look. Thank you, sir. I am now officially Chris Skinner. So to do that, I guess I'm going to start with just looking at what is the business structure of finance, and particularly of a bank. And the way I'll do that is that there's a lot of books and seminal research that's been out there. But for me, the simplest way of looking at a bank is to say that in the back office, we have this organization that produces products and services, which is typically focused upon product centricity in terms of the rates and the structures of mortgages and loans and credit. That then in the middle office is connected to customers through an infrastructure that must be fault tolerant, ultra high resilient, and always get everything right every single time, never drop a payment. To a front office that is meant to be customer intimate and to be giving the best experience that we can give to our clients. And that's across multiple business lines: retail, commercial, investment banking. And some banks are good at this, most are average. Some are very good at some things, but they're not good at everything. And in fact, this business model applies to any company. It could be any organization in any industry, because it's based on a book by Michael Treacy in the 1990s and Fred Risimer called The Disciplines of Market Leaders, which says that every company basically has a manufacturing, a processing, and a retailing organization, of which one excels over the others. And this is quite important because it's actually fundamentally the way in which I see the business being changed by technology. Because another book that I grew up with in my business experience was called Reengineering the Corporation. And I spent a lot of time trying to get banks to transform their business operations through an approach of vision rather than incremental improvement. But it's very difficult to get banks to buy into a transformational vision because it's disruptive and they want to avoid risk. So they always had incremental improvements. But when you look at Reengineering the Corporation, the basis of that book was that you have a back office based on products, a middle office based on processes, and a front office based on people, that connection between your staff and customers. That's where the human engagement really occurs. And then what you need is strong operational excellence infrastructure to help those humans engage effectively with differentiated services. So this is the world of the 1990s, the markets of leaders who have disciplines based around retailing, processing, and manufacturing, and the understanding of how to transform the business or evolve the business through improvements in processes, technologies, products, and people. But this is radically changing right now. And this is the world of 2017. In fact, it's been the world of the 2010s, and it's transforming very quickly. My first fintech company I ever met is a company called Zopa, which is a UK peer-to-peer lending company, who presented at the club that I run. I run a networking group across Europe, on March the 30th, 2005. So the fintech revolution is 12 years old. And what they presented was an eBay for money, connecting people who have money with those who need money. And what I realize now, looking back, is that the world they were talking about, which no one understood in 2005, is pretty clear today, which is we still have products and services that people need, but we provide those today through platforms that give great digital experiences. And this is the world that we have to contend with and compete with now. We don't have physical distribution structures that we had in the industrial age. We have digital distribution structures on platforms for the internet age. And you can see that quite clearly by what's happening with the companies that everyone talks about, like the Ubers, connecting people who need rides with those who have cars. That's a platform experience. You can see that through people who are traveling and they need rooms to stay in, and some people have rooms, so you have the largest hotel chain that owns no buildings called Airbnb. And then you have other industries that are competing in a slightly different way, not just on platforms, but they have to have content and they have to have experiences that are amazing, such as Netflix, because Netflix is competing with Amazon and others, and therefore they have to differentiate through their product content on their platform. A slightly different structure, but one, again, that's becoming highly competitive with the mainstream media. In fact, the mainstream media of the last century are disappearing. This is the mainstream media of this century. So when you look at the industrial era companies, they're kind of failing because they're no longer needed in a sharing economy, in a platform economy. Because in an industrial era experience, we were building and heavy lifting lots of product and assembling that product and integrating that product and distributing that product and servicing that product. And that's gone away. That's not needed anymore. What you need is just connectivity and the ease of getting what you need on demand. And that's the platform economy, which is the reason why we see so many companies arising as giants in this age, just because they do this so simply and easily and allow everybody to operate in their marketplace. In financial services, as I've already mentioned, you have companies that if you need something like you want to buy a car, you need to connect with credit, so someone who's got money, and you do that through a platform, such as Sophie or Prosper, a marketplace. And that's what's really interesting right now, which is this massive reassembling of the financial system with very specialist players who are tackling every single piece of the system with a narrow, specialized approach through an app, an API, or an analytic engine. And I think of this as the apps, APIs, analytics age, where any company can launch and deploy something into this marketplace that, if it's good, will grow into a unicorn. And they're doing one thing really well rather than trying to do everything averagely. And this is how the incumbent institutions have to rethink their role, which is they do everything averagely. You can't compete doing something averagely with hundreds of companies doing one thing really well. So you have to rethink the business model. And so when we look at the apps, APIs, and analytics that are out there, and that really maps into my front, middle, back office structure, then you see some of the things that are happening, such as the apps that allow the Internet of Things to start to transact and trade. How can you have billions of things transacting trillions of dollars every single second of the day through a Swift counterparty branch network-focused structure? It doesn't work. So we need something that's an Internet of Value, which underlies the Internet of Things, which has to be built using an open marketplace of apps, APIs, and analytics. The APIs are connecting front, middle, back office. And in the back office, the engine and the real challenge is going to be how we leverage our data understanding of our customers. Data is the oil, and it's the thing that really is going to be the battleground for competition. The challenge that a lot of incumbent banks have is that they don't have a good grapple on their data because it's locked into heritage systems that are fragmented amongst many different products and decades of fragmentation structures. How do you rationalize that data into something that can really understand the customer? Because the real battle is to know more about me than I do. I call it the semantic bank. You have the semantic web that connects everything. The semantic bank knows more about me and my financial lifestyle than I do, and advises me proactively, predictively, cognitively to make sure that I live smarter, save better, and enjoy my needs as I need them fulfilled financially. And that will be done through a marketplace of lots of different components that are assembled into great experiences. So when you look at the world of today and see all of these hundreds of startups that have billions of dollars invested in getting started, you realize that something fundamentally is changing. I was just on a tour, and I say a tour because it felt like it, with some friends in Sweden and Norway, where we presented the marketplace of finance. And these are all brand new companies that are just starting up. Not all of them, in that Saxo Bank's been around for 25 years. But it's interesting. This is one of the few banks that really gets the idea of the marketplace of apps, APIs, and analytics. It's a Danish bank that offers all of their capabilities for capital markets through apps, APIs, and analytics to traders and market makers and brokers. They control nothing. They offer everything. Different way of thinking. Similarly, Solaris Bank from Germany focused originally on creating an ability for fintech startups to have the financial capabilities they need on a smorgasbord of APIs, and then discovered that their main clients aren't fintech startups, but merchants online who don't get what they need fulfilled by their banks because their banks want to give them everything rather than one thing. This is something that's changing. So, for example, Bud, a London-based startup, offers an amazing consumer-focused experience of APIs for financial services that banks can use. And many of the big banks are talking to Bud to give better consumer experiences by using their technology plug-and-play capabilities. We have the first brand new clearing bank in Britain for 250 years, just launched in February, called ClearBank, that has amazingly allowed easy access through one API into BACS, CHAPS, and all of our clearing systems, which historically have been controlled by the big banks at high cost and exclusivity, and with great difficulty. Now it's just plug and play. We have a company in Dublin called Leveris that if a bank's struggling with migrating their core systems because they're old and creaky, they can do it piece by piece through the APIs of Leveris. Their focus is on when you have to eat an elephant, do it one piece at a time. That's how you migrate your core systems. In fact, the biggest apps, APIs, analytics marketplace out there right now is in China, which is Ant Financial, part of Alibaba, but spun off into a separate company last year, worth $60 billion, which is kind of worth like two Barclays banks, 3 Deutsche Banks. Not bad for a new spin-off company. And I wrote about them recently offering an apps, APIs, analytics marketplace in China, where the biggest banks like China Construction Bank are taking their services to fill the gaps where they're weak. And someone wrote to me from Asia and said, I'm talking rubbish, this is impossible. It was a senior banker with one of the Asian banks. I replied, you may think that, but it's happening. It's not fiction, this is real. The marketplace of digital financial services where everybody can engage and everybody can create something where you focus on doing one thing really well rather than everything averagely. So for the incumbent institution, they have to transform, and I think they transform into a curator, where basically they have the marketplace opportunity because they have the millions of customers, billions of capital, centuries of history, to curate all of the startup APIs, apps, and analytics out there into amazing customer services and experiences that have far greater reach, depth, and breadth than a financial institution has ever had before. But to do that, they have to open source themselves and stop being control freaks, which is historically what banks have been. Proprietary control freaks. They have to become open collaborators and co-creators, working with the global institutions of specialist companies in the digital ecosystem. Because when you look at the $100 billion in the last 4 years that's been invested in fintech, and all those startups that I just pointed out, they actually focus on doing a few things really well in some cases. And it's a granularity that's just starting to come through. Some of them focus on machine learning, artificial intelligence. Some of them are focusing on payment wallets and payment APIs. Some of them are focusing on distributed ledger, shared ledger services. And fintech isn't just fintech, it's insurtech, regtech, wealth tech. It's lots of tech that's across a different range of services than we've ever seen before. And it's the reason why, just as the industrial era companies are dying in this age of platforms, the industrial era banks will not survive if they stay proprietary and internal. Because this world is moving very quickly into one that's global platforms that collaborates with everyone. And that's the reason why you can see JP Morgan Chase, the most highly valued bank in the USA, is not competing effectively with a 6-year-old upstart called Stripe, who's producing 22 times more value per employee because they do one thing really well rather than everything averagely. So for Jamie Dimon and his colleagues, the real challenge is how do you become a co-creator, collaborative company when you've been used to being a control freak proprietary organization? And I think it's illustrated really well by a recent meeting I had in Oslo where a new startup company, Spiff, were introduced by Nordea, a traditional Nordic bank, as a partner. And the Spiff CEO had the opening line that his 3-year-old son likes to play with dinosaurs, so do we. Huge respect for his traditional, long-standing partner. And I think the way in which I see that being illustrated is that I deal with a lot of banks, boardrooms, and chief executives. And when I walk in, I find the room is often a lot of old men. It's kind of not got a great deal of diversity. It doesn't have a lot of technology vision. It has a lot of history and compliance and risk understanding and regulatory understanding, and a lot of can't do this attitudes because they've been in there for 20 years and know what they can and can't do in their heads, even though in reality it's not true. You know, there's a recent survey I picked up that shows that 94% of the C-suite of the biggest banks in the world have no experience at all of technology. They would have no understanding of the difference between artificial intelligence and machine learning. If I asked them to define the difference between a distributed ledger and a blockchain, they wouldn't have any idea. Because it's technical, I don't need to deal with that. Why should I know the difference? Well, the reason they should know the difference is that if the next generation of financial services is based on these technologies, surely it's a fault not knowing what those technologies are. A fundamental flaw. Equally, how can you transform a business from being a physical distribution structure to a digital distribution structure if you do not understand or know what digital distribution structures are? Reuters published this the other day, which is that 43% of the US big banks' core systems are in COBOL. This is a development language that I learnt using punch card programming in the 1970s. I'm not quite that old, but I did do COBOL, and it's good because now I can come out of retirement and get $300,000 or $400,000 a year programming for big banks. That's what they're doing. They're trying to get guys off the golf courses to come back and work for big bucks because they don't have anyone who can maintain their systems. And that's okay for the next few years, but these guys are dying. You know, come on, we've got to reinvent this, otherwise we won't survive. And that's my final comment, which is to really reinvent the financial industry for the internet age of marketplaces. You have to have, as an incumbent institution, a fully committed leadership team who understand where you're going, how you're going to get there, and what it is that you're doing from a intimacy with the technologies involved. And if you don't have that, then the incumbent institutions will not survive. Thank you.
Does everyone hear me? Okay. Now I hear myself too. Chris, very, very interesting presentation. I think much of what you've spoken about would probably be useful to the 20 or so startups who are going to be here this afternoon in day 2 of our program, which is why it's Innovators and Investors Day. So I have a question for you. Are we seeing an evolution or a revolution?
I think you tell from what I was saying, Michael, that I wholly believe this is revolutionary. And in fact, I think I can prove it. And that when you look at how humans behave from an anthropology viewpoint, then there's probably been 3 revolutions historically in how humans behave. The first was becoming human, Homo sapiens ruling the planet, which has been the focus of a book which has been very successful called Sapiens, which my takeaway from that book is the core of humanity is that we share beliefs, which enables us to work in large groups. Then we became civilized, which was in ancient Mesopotamia 5,000–10,000 years ago, where we invented money to enable cities to be civilized and for thousands of people to work together effectively. Then we became commercial and industrial in the Industrial Revolution, where we invented banks. And banks are invented as a trusted store of value, of money, by governments, which is why they have licenses and are regulated. And now we are becoming digital. And one of the big differences is that becoming human, we lived in groups of hundreds. Becoming civilized, we lived in groups of thousands. Becoming commercial, we live in groups of millions. Becoming digital, we've become a group of billions, because suddenly 7 billion people on Earth are connected in real time, globally, immediately, and can trade, transact, and talk. And that, to me, is a fundamental revolution. It's not an evolution.
I think that answers the question. So I'm sure many of you are eager to ask a question. We don't have much time, so do we have the microphone in the audience ready? Any questions? Okay, we've got one. Do we have a microphone? That was my cue. All right, there we go.
Brad Pragnell from Consulting for Payments Canada. Great presentation, Chris. Always big fan of your blog. Been reading it for many years, and good to see you in person again. My question is about what the big banks are doing at the moment. So a lot of the big banks in, well, the 2 jurisdictions that I've worked in, both Canada and Australia, they're setting up their own. They're setting up their own hubs. They're releasing APIs. They've got the strategy to engage with fintechs. They're letting people walk around without ties. So, you know, there's a real attempt by the larger banks to try to engage with that community. To what degree do you think that engagement is genuine, or to what degree do you think it is, I don't want to say marketing or spin, or to what degree do you think that they haven't quite progressed to the point where they need to get? I'm kind of curious to know your take on to what degree you think is genuine and what degree you think is just them kind of dabbling on this.
Thanks, Brad. I have a few litmus tests that I use to see how fundamentally and seriously a bank gets the digital revolution we're going through. One is whether they use terminology like channel and omni-channel. And if they do, I immediately start to feel slightly ill, because it's obvious that that's not the right terminology. I put channel along with the use of the word tape. as in, I'm going to tape record something. It just doesn't happen anymore. Equally, if they talk about multifunctional teams, I feel nervous because functions tends to mean that you've got product silos, and product silos don't work in a digital ecosystem where you need to have an enterprise view of the customer and of the business. And equally, I've met quite a few hackathons and accelerators and startup days where I've been informed by some of the startups involved in those days. Afterwards, they discovered it was just a marketing program as an investment by the bank to look like they're hip and cool and trendy. So to really get this change, it has to come from the leadership team. And when people say to me, who's stand out in financial services from a digital perspective, there's very few on the list, but the few on the list are companies like USAA, because USAA have never had a physical distribution structure. They've always had a remote digital structure that they've had to serve the armed forces with. Capital One, who pretty much get it because their leadership team has a lot of digital people, technology people in the leadership team. BBVA, because the chairman of BBVA, Francisco Gonzalez, was a programmer when he started his career and has brought in a C-suite that's fintech. And by fintech, if you look at the fintech startups, they tend to have a young visionary CEO who quite often will be a lady, which is always interesting because you don't see many of those in the boardroom of the banks, well, not as many as there should be. And equally, they're often millennials that then bring in maybe some mentors to help them understand the financial markets. And I put up that picture of the boardroom of a bank for that reason, because banks are fintechs. That's what they are. They're financial technology structures that are distributing financial services through the internet today. And they need to have that diversity in the executive C-suite. And if I see that, and there's a few banks that do have it, then I feel confident that they get it.
Quick question from me, Chris, is just like tape recorder or Xerox or something like that, we can't seem to shake the term bank to describe anything that does some sort of financial transaction. We're getting to fintech, but I think like in India, they've got these transaction entities called payment banks, right, which are, they don't give credit, so they're not really banks. Suppose the EU's got a right calling it a payment institution. It's more representative. Let's talk about the US. What do you see the vision here in the US? And we had the OCC talking about what they plan on doing. Where do you see it going here? Do you see an Apple Bank, as the press says?
Is the OCC going OTT? I actually, again, because of traveling so much, think that we've ended up with a three-stream world where Europe and America is in a legacy economy. And by that, I mean that we live in an economy that most of the infrastructure was implemented before Mark Zuckerberg was born. Yeah. And that's a challenge because we're now trying to reimagine that infrastructure for this age. And an awful lot of institutions are trying to evolve the legacy infrastructure rather than trying to replace it, because replacing legacy infrastructure is tough. It's a big risk and a big ask. But if you go to China, in particular China, but also India, then you see the growth economies have leapfrogged the legacy economies because they didn't have that aging infrastructure. And China didn't have a lot of debit and credit cards out there with consumers. And last year, Chinese consumers transacted $5.5 trillion through their mobile apps. The USA is $112 billion. That's the difference, an order of 50 times magnitude in the digitalization of payments in China. China's cashless, and yet here, I get challenged if I don't show my ID with my mag stripe. It's kind of a little bit...
Yeah, we're still a chip and sign, yeah.
Yeah, although having said that, my taxi driver this morning did say, "You're paying with cash?" I said, "Look, I'm old school." And then you have what I call the innovation economies, which is, in particular, the sub-Saharan African countries, Tanzania, Ghana, Nigeria, Uganda, Kenya, where, as I say, you have an ATM every 5 meters. It's a mobile money human being agent. But having said that, they've really embraced this mobile network inclusion very quickly, such that in most of these countries, more money is moving through the mobile network than through the banking system. 1 in 3 people who have a mobile subscription in sub-Saharan Africa use that as their mobile money account. And mobile money wallets, if you want to see where the highest density is, it's in those countries. Also Philippines, Indonesia. So I think we have the innovation economies that had nothing before and have just are reimagining everything through the mobile network. You have the growth economies who have leapfrogged. And then we have our challenge, which is how do we get rid of all this old COBOL stuff?
Hi, I'm over here on your left. I'm Sonia Kelly from the Center for Financial Inclusion. Hi, Chris. I love your blog. Thank you for coming. I've just been doing some research over the last few months with the Institute of International Finance, interviewing their members and asking these mainstream financial institutions, banks, insurance companies, and payment companies about their partnerships with fintechs and why they partner and what that looks like. And one thing I heard over and over again, almost in every interview, was, we are not a technology company, and that's why we're partnering with fintechs. But they didn't seem bothered by that. They kept saying, like, if this partnership works out, then we'll either learn from the fintech and just absorb the technology and start doing it ourselves, or we'll buy them. And so I tweeted that figure that 2 out of 5 banks have a technologist in the room, and I think that's really compelling and not a great sign for the banks. But I'm just wondering, if they can just buy innovation, do they have to be innovators? And should banks feel threatened or uncomfortable with those figures, or should they just sit on their big stacks of cash and say, we can adapt with our money?
Thank you. And it's an industry culture that we can get away with being fast followers. And therefore, we wait until something has been proven before copying it or buying it. And that's been something that's been endemic as the industry attitude for years. What I find interesting is that Walter Wriston, who was CEO and chairman of Citibank back in the 1970s, said that information about money is becoming more important than money itself, followed by John Reed, his successor, who said banking is just bits and bytes in the 1980s. And when you think that that's the view back in the 70s and 80s, to think that we're not technologists and we don't need to get technology just kind of strikes me as being a little bit sort of facing the wrong way. It's looking in the rear window. So the banks that think they can just acquire and fast follow are probably going to find that they're looking in the rear window mirror and might find that there's a crash coming soon.
Okay. We time up.
Hi, Chris. My name is Maria, and I have a
Could you take it offline? I think we're over time, so if you could, please. Thank you. Thank you, Chris. Thank you, Mike.
Thank you.
That was great as usual. We're going to go on to the next session. Thank you.